Hello, and welcome to the October episode of Economy Watch. My name is Eric Lund. I'm a senior economist here at the Conference Board, and thank you for taking the time to join us this morning. Today we're going to be talking about the economies of France and Germany and what the impact of COVID-19 has been. We're going to be looking specifically about how the pandemic has unfolded in those countries. We'll be discussing how leaders in those countries have responded, the extent to which the economies have been impacted thus far, and then sort of a broader global picture in terms of how France and Germany fit into the global economy and what COVID means in terms of that. As always, you can get CPE credits for joining us today. Make sure to put your full name and email into the space provided. There'll be a number of pop-ups that you'll need to click during the duration of the program, and you'll need to stay online for the entire portion of the program. I'm joined today by three fantastic speakers from the Conference Board. Ottoman Ozildirim is the Senior Director for Economic Research and the Global Research Chair. Ottoman, thank you for joining us.
Good morning, Eric.
We have from Europe. Also, we have from Europe, Ilaria Maselli, a senior economist in Europe. Welcome, Ilaria.
Thank you, Eric. Hello, everybody. Nice to be back.
Great. And of course, last but certainly not least, we have Klaas de Vries, also in Europe. Klaas, thanks so much for joining us.
Thanks, Eric, for having me. Looking forward to the discussion.
Great. So as we always do in every Economy Watch, we briefly touch on the current thinking on the U.S. economy. We update our forecast every month, so we'll be exploring that, and then touching on the global economy before we dive into the special topic of France and Germany. So in the U.S., things in terms of COVID-19 had felt like they had been doing fairly well. Following a pretty troublesome summer, the number of new cases and the positivity rates had been declining. But really over the last week or so, we've started to see an uptick in various parts of the country, which is something that we're watching closely and a little bit concerned about. One of the big downside risks we see for the fourth quarter is a large increase in cases here in the U.S. At this point, we don't think that's sort of the base case scenario. We do expect some case levels to increase, but we think they'll be sort of localized and that local governments will do a better job than they were able to do in April in terms of confronting it. So something to continue to watch, something that is very important in terms of our outlook. In terms of the way the economy has been performing, you know, we've had a number of sort of green shoots in various industries here in the U.S. The housing market, for instance, is doing relatively well. We're seeing businesses start to do new orders for equipment, which is a positive. But some of the recovery that we've been seeing in some of the more critical sectors like consumption, which accounts for about 70% of the U.S. economy, have been starting to fizzle out a little bit. If you look at the top left chart here, you can see that the degree to which the unemployment situation in the U.S. Has been improving seems to be stagnating to a certain extent. And so we still have relatively elevated levels of unemployment that eats into people's ability to spend. On the top right, you can see consumer confidence. We've seen, that's the blue line. We have seen an uptick in that last month, which was encouraging, but it's just a single month, so we're not reading into it too deeply. And of course, it's still far below where we were before the pandemic hit. On the bottom left, we have a slide on, it's a little small, that is personal savings rate. One of the interesting things that we've seen really since the pandemic hit is that the level of household savings that's occurring has gone up quite a bit. It was up to the tune of about 33% or so earlier in the year. It's back down now to about 14% or so, but that's still about double what it was coming into the pandemic. So still, households are not willing to spend as much as they were. And all of these three kind of come together in the bottom right-hand corner, where we're looking at personal consumption expenditures. This is the amount of money that people are actually spending online and in stores. So with elevated unemployment, with high savings rate and with consumer confidence that hasn't fully recovered, we're not seeing that spending really continue to climb, and we're pessimistic that we're going to have a strong sort of consumption driver in the fourth quarter of this year. We have a poll question as well. There's one topic that I haven't touched on yet, and that's the U.S. elections that are coming up in November. We've been talking here at the conference board about whether or not whether there's any potential ambiguity in the outcome could have a business impact, and we thought we would ask you. So the question is, as the U.S. election approaches on November 3rd, there's some concern that an ambiguous outcome is possible. If there's no clear winner, will there be any implications for your business? The first answer is yes. A contested election would likely have a meaningful impact on my business. Two, yes, but it depends on how long it takes to declare a winner. And the last one, no, any delay in the results would not have an impact on my business. So let's go ahead and lock that poll up if we can. All right. So it looks like a little over half of you don't think there will be any impact on your business. I think that kind of makes sense in terms of what we've been talking about. But there is the increased level of policy uncertainty that comes with that potentially. And I'm looking here and I'm seeing that 26% say it depends on how long, and 16% are saying it does have a meaningful impact. So it looks like there is some exposure to this that in addition to COVID-19, in addition to government stimulus, and whether or not that occurs in the U.S., any kind of ambiguity surrounding the election looks like it could be harmful as well. Ottoman, do you have any response to what the audience is telling us here?
Yeah, I think this distribution is not too surprising. In general, markets and businesses don't like uncertainty, and the longer and more drawn out the uncertainty is, the worse it is. But if it is in the case of a contested election result, or we don't know when the results will be certified. By the way, the deadline is in early December, so it has to be done by then. If it's temporary, obviously it has less of a blip on your economic data or on your plans. I think the larger uncertainty is about the U.S. administration, the next U.S. administration, and that's probably already built into the plans and contingency.
Thank you. Ilaria, Klaus, any perspectives on U.S. politics from Europe? Ilaria, we can't hear you.
Yeah, sorry. No, sorry. No, from here I would say that what matters more than the results and the possibility of contesting the results is who actually wins. Because a lot of things could be different, for example, on the trade dimension, which has been, of course, a big concern in not only between U.S. and China, but also with some influence here as well. So from a European point of view, I would say that the change in administration or not change matters more than the actual discussion about the results on the 4th of November.
Good input. Thank you very much. Let's go ahead and take the poll question down and do a little bit of exploration on our most recent forecast update. So as some of you in the audience may know, the Conference Board has been using sort of two approaches to making its forecasts this year. We have what you're looking at here is an industry-based approach where we're basically cutting the U.S. economy into individual industries and then adding it all back together again. That gives us the ability to build sort of individual narratives for how we think COVID-19 is impacting the mining industry or manufacturing. And so we can have a sort of a granular discussion and forecast on these industries and then tie it together to give sort of a big picture GDP number. We're also able to do this at a higher frequency on a monthly basis as opposed to just a quarterly basis. So our base case scenario is the black line that you're looking at. We had a pretty precipitous decline in April, but really a stronger rebound over the summer than we had originally expected. That having been said, we're concerned about the fourth quarter, as I think I mentioned earlier on. the supply side shock that was initially set off by the lockdown and by COVID-19 earlier in the year has sort of migrated over to the demand side, which is that slide that I just spoke on a few minutes ago. And so we're concerned about spending, we're concerned about a lapse in demand, and we think that it could really slow down U.S. GDP growth in the fourth quarter. Following that, we expect things to gradually improve over the course of 2021. We have an upside scenario as well. That's the orange line that you see. This scenario assumes that the strength that we saw over the summer continues, that the labor market continues to heal, that the U.S. government continues to offer additional stimulus sooner rather than later. These are all sort of a more optimistic picture of where things could head. And then this month we actually reintroduced the downside scenario as well, which is the blue line. If COVID-19 picks up dramatically in the U.S., if there is no government stimulus, if there is a long-term delay to the development of a vaccine, and if there's a lot of volatility around the U.S. elections, we can see a situation where we see a more pronounced sort of double dip scenario in the fourth quarter. But then again, a gradual recovery into next year. So that's our sort of our three sort of pronged scenarios for October. We continue to update these every month as we get new data, so make sure to keep an eye open for the next version of that. We also, of course, map the base case scenario into a expenditure GDP model, which has all the classic elements that a lot of you are used to: consumption, investment, government spending, et cetera. So for the year, we're expecting, according to the base case, about a 3.5% contraction, 2021 rebound of about 3.5%. And that is the quick overview of the U.S. forecast. I want to hand it over to Ottoman. He's going to talk to us a little bit about our perspective on the global economy.
Thanks, Eric. So I promised Eric to take just 5 minutes on the global economic outlook overview, and I know that he'll hold me to it. But this is really just a teaser anyway. We are launching our annual benchmark on the global economic outlook on October 28th, and next month's Economy View webcast will go deeper and dive deeper into those numbers to understand the global short-term and long-term. So, you know, the global economy is really going through an experience that's very similar to what Eric was just talking about in terms of the economic impact. The restrictions to movement and the lockdowns led to a sharp contraction in the first half of the year, and you see how correlated it is with the mobility measures. So, of course, you're telling consumers and workers to stay at home. They're not going to work unless you can work from home. That shuts down economic activity and reduces economic output in all these countries. And it is really synchronized all around the world. According to a report that I saw, only 10 countries around the world were not affected by the pandemic, by the virus, and they're all in the Pacific Ocean. So that tells you the global integration of our economies. The immediate impact of the lockdown and the subsequent reopening is much more visible in the services sectors. Here you have numbers from the purchasing managers' surveys and looking at manufacturing and services. Services are much more affected and much more directly affected by the stringency of the containment measures. You can still continue some of the manufacturing activity, some of the construction activity, if the workers are not crowded together in one place. So the exception is sort of the meatpacking industry, right? But other types of manufacturing could continue to some extent, and that's why the contraction may not be that great. And also manufacturing uses a lot of automation, right? So fewer workers, but services is much more labor intensive. And delivering services requires closer contact with your customers. And also it requires that larger groups of customers come together, like in restaurants or airlines or movie theaters. So That explains the deeper contraction. So more impact for those services sectors, and the recovery is going to be much more dependent on whether an effective treatment or a vaccine is available and widely distributed. So that's really the key in the reopening recovery of the economies. So faced with this pandemic and the economic impact and the synchronized shutdown of the global economy, governments came to the rescue. Large stimulus packages helped to maintain employment, incomes, and they also help businesses to stay afloat and avoid bankruptcy. But we're still in the earlier stages of a recessionary downward spiral. So I think we need to watch that carefully, whether the stimulus that's cushioning the blow is going to be enough or more stimulus is needed. You know, the stimulus so far, very large for mature economies. It really helps to put a floor on the contraction and cushion the blow. And it's not quite enough to put us back on kind of a sustainable growth trajectory. Emerging market governments supported the economies largely through more spending and tax cuts or deferrals, postponement of taxes and revenues. Mature economies supported businesses to stay afloat through generous loan terms, a lot of stimulus through loans and guarantees, and support for keeping employees at work, working or on the job. So that has helped to some extent prevent a deeper downward spiral in employment and spending. But the labor market impact has been very large, and that's difficult to reverse. We've seen a lot of unemployment, a lot of furloughs, and we're also hearing that some of those furloughs are being converted to layoffs. So there's likely more in the pipeline there. So globally, employment is only expected to recover halfway back to where it was at the beginning of the year. And more recovery requires more time, and again, for the business activity to kind of return to normal, and we're still far from that. And all of that leads us to the global economic outlook that has global growth rates for 65 to 66 economies around the world in 11 or 12 regions, which we'll be releasing on the 28th. Here is a preview of that, looking at the US, Euro area, Japan, China, and the global average you see is the black dotted line. And China has been ahead of everybody else. They went into the pandemic earlier, experienced a fast rebound, and so far they seem to have the virus under control. And they kind of returned to their long-term transition of a gradually slowing economy, and they're leading the recovery for the global economy here. And then the various varying degrees of recovery for U.S., Euro area, and Japan. I think it is interesting to look at a little bit more detail on the European economies. One of the recent observations is that their second wave might be arriving. So, these numbers are conditional on a more controlled second wave. But we might have to come back and revise them if we see sort of a more severe resurgence. So that's always a wild card in the outlook. So with that, I will turn the discussion over to Ilaria and Klaus to talk more about the French and German economies as the devil's in the details.
Sure. Thanks, Ataman, for setting us up there. And indeed, as you already mentioned, the fear of a second wave. I think in Europe we are already clearly in a second wave, at least if you look at the confirmed cases, which have been going up very rapidly in the last couple of weeks. The WHO has called the situation worryingly in Europe. And you can see here on the chart the positivity rate, so the number of tests that come back positive, which have been creeping up pretty much constantly over the last couple of weeks, as you can see. And the European numbers are probably already a little bit above the US, whereas throughout most of the summer they have been below the level in the US. So we've seen over the past weeks, and we're actually in the middle of it, that countries are sort of reinstating stricter measures, trying to contain the spread. You know, this is sort of the hammer and the dance. You try to reopen your economy, loosen the restrictions, but then the case numbers go up again. So you have to, when some measures don't work, they have to bring back sort of the proverbial hammer to kill the spread of the disease. And we've seen that happening in a couple of cities, a couple of regions. Madrid, for example. Also, the Netherlands yesterday came with a new set of measures, and you see that happening across the continent. I think our view is that so far at least they will have less of an economic impact as they had in March and April, as you saw some of the numbers that Ataman showed. First of all, I think because there have been some lessons have been learned on what works, what doesn't work. So, for example, in Belgium, they already the lockdown was pretty severe because they closed down all the shops, for example, and now they notice that that's not the biggest spreader of the disease. So it's yeah, in that sense, we think it has less of an impact there, but still it should be something that we need to watch carefully.
Hey, Klaus, I had a quick question. I'm looking at this chart, and one of the things that kind of jumps out to me is that the positivity rate in France appears to have really been rising a lot faster than it has in Germany. Is there anything behind that? Why France has been sort of grappling what appears to be a little bit, more with more than the Germans have right now?
It's difficult to make these comparisons. France had a very strict lockdown, and it could be that they reopened a bit faster, whereas in Germany it was a bit more smoothed out, so to say. So it could be related to that. They reopened too quickly. Yes, sure, go ahead.
No, so I would reverse the question of Eric, and because I think we see positivity rates increasing and number of daily cases increasing. So the question is rather, how do they do it in Germany? Because that is the exceptional case in a way. I mean, it was already an exceptional case in the first wave. Already in the first half of the year, they had fewer cases, fewer number of deaths. One statistic that really influences here is the testing capacity of Germany. So they test really broad. They test everybody. Whereas in other countries given that there's been an increase in the demand of testing, and I definitely see this in Belgium from my own experience in the last week, because testing capacity is limited, then what they ask is to test only people that have symptoms of people that have been in touch with other people that have been confirmed as a case. And so that in a way, I would say there is probably a sort of bias in the statistics on positivity rates because it depends on the policy of the country and on the testing capacity. But Germany is really the example on how to deal. If we would all love to be German in that sense, to have the capacity to manage this like they have.
Yeah, that's a good point, Ilaria. I think France is probably not even the worst country. We could have plotted other countries like Spain or Czech Republic, Hungary. Interestingly, Eastern Europe, which didn't really have a lot of cases in the sort of March and April period, they are seeing a lot of cases now. So yeah, it's interesting to ask why these countries like Germany, but also some others, have been able to suppress it better. Now, if we move on to sort of set the stage for France and Germany on a economically speaking, so to say, and to compare it a bit to the US. So we have this table here with some of the main indicators. The first line shows you the share of the French and the German economies in the global economy. So this is sort of a measure of their global clout. As you can see, it's about a third of the US in terms of PPPs. Now, as we know, Germany punches a bit above its weight in terms of manufacturing. It's really one of the main manufacturing powerhouses in the world. And you can see that they're actually, while their economies accounts for 4% of the global economy, they're actually taking 5.5% of all sort of manufacturing demand in the world, which is quite a lot. So this is not just products that are being produced in Germany, but this is basically German intermediate goods going to China or US or whatever. This counts everything basically. So now France punches above its weight in terms of tourism. So as you can see, the numbers, I put here the numbers for 2018. So more international arrivals than the US, and much more than Germany. I think Paris is one of the most visited cities in the world. And this, of course, also explains a little bit why, partly, I guess, why France is being hit much harder by the pandemic. We saw the chart from Ottoman showing all the countries, or a subset of countries. I put the numbers here below under pandemic impact. So the first half GDP change relative to the second half of 2019. So you can see that France has been hit much harder than Germany. Part of this is indeed, as I said, the tourism exposure. Obviously, people cannot travel now. There's a lot of restrictions on international travel, but also travel in between Europe as well. And the other thing is that, as Ataman also alluded to, the service sector is generally much more exposed to the restrictions, and France has a much stronger service sector than Germany has. So that's another explanation. Then going up a little bit on the productivity and growth statistics of the last couple of years. So as you can see, the productivity level is very similar across the three countries. A very high rate globally. This is one of the only couple of smaller economies have higher productivity growth rates, but this is really globally at a very high level. I should mention that Germany and France have higher employment rates, especially Germany. So they manage this high productivity rate and combine it with having a very high share of the proportion of the people in the labor force. Now, growth over the last couple of years obviously has been a bit stronger in the US, but Germany and France not far behind with 1.8 and 1.5%. US had a very strong labor market. Because the productivity growth rates are largely the same over this period. And last but not least, we put the stringency index values. As I said, France had a very strict lockdown compared to other countries in Europe, for example, Germany. But currently, at least according to the Oxford University, they're at a similar level, around 46, where 100 being the most strict. Having the most.
Yeah, Klaus, maybe you could quickly explain what the stringency index is exactly. I'm sure the audience may not be familiar with it.
So it's a measure that the Oxford University brings out, where they sort of compare most countries in the world on a range of measures regarding how strict the government measures are to sort of restrict the spread of the virus. So it looks at are schools open or not, how can you go to parks, are shops open, all those kind of things are sort of quantitatively assessed and being brought together in
I hear Klaus breaking.
Yeah, I think we have a little bit of a connection issue with Klaus. Maybe we can pivot. Ilaria, I know that you have a bit of material too. Maybe we can talk a little bit about some of your thoughts, and then when Klaus gets his connection reestablished, we can bring him back.
Sure. So just taking over from Klaus on the last line
Hello?
of this
Sorry.
part, I think this is something that is going to change for sure. The stringency index, actually, Macron, the French president, is speaking tonight, and they expect an increase in the restrictions. So this index will probably move upwards, at least for France. There's been some measures in Germany. For example, for the city of Berlin, some limitations have been added. For example, how many people can go to restaurants and when bars have to close. But given the way the pandemic is evolving, probably in Germany, we might not see restrictions moving upward in the next 2 to 4 weeks, probably. Now, going to the economic side of all this, I put here a couple of charts with the Purchasing Managers Index for France and Germany, and I thought it was very useful to divide between manufacturing and services. This already, Ataman discussed that at the global level, but I think in the countries itself it matters a lot. And so what you can clearly see here is that the manufacturing sector, which is the blue line for the two countries, has recovered quite well. Actually, very strongly in Germany. The PMI for September was 56. So very, 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 very high. Imagine that it was not super happy already before the start of the pandemic. It was going below 50, and we were watching it in January, February, going there at the limit. Then no need to say it went down after the start of the crisis, but as the lockdown was lifted, it recovered quite well in both countries. Now in Germany it moved up, in France it's moving a little bit sideways, but it's above 50 in both cases. What is more difficult is probably, perhaps on manufacturing, one more thing which is important also for what comes after is the fact that the manufacturing sector employs 25% of workers in Germany and 20% in France. So 1 in 4 workers in Germany works in the manufacturing sector and 1 in 5 in France. So that's important when at some point we will get worried about the labor market. We should keep these figures in mind. Now on services, the development of the services PMI is, no need to say, more erratic. Obviously, big jump downward south in the lockdown. Then it actually recovered a lot. More in France, where the service sector matters and where, given all the limitations, still there was some tourism in the country during summer. But then, if you look at the last couple of months, if you look at August and September, already actually probably at the end of July, there's been an increase in the number of new cases, and that determined the fact that activity in the service sector has started to decrease again. And so, given where we are now, where you've seen in Germany the number of cases is increasing, and there is a risk of new restrictions in France especially, I don't think there is a lot of optimism on this for Q4. So that will have an impact for sure on the economy.
Ilaria, can I make a quick comment?
Please do.
What I think is interesting also on the Germany side is the strength of the manufacturing sector. So as you can see, throughout most of 2019, the manufacturing PMI was below 50, so it was in contractionary territory. Obviously, they had a lot of trouble with the global environment was very challenging with the trade war between China and the US. And there were also a couple of country-specific factors, I think, that made the industry sector have a very bad year last year. But it seems that they are doing really well after the sort of the rebound from the pandemic-related lows there. I checked with some other survey data, for example, the IFO manufacturing survey data, where they poll business leaders in manufacturing in Germany, and they're also quite optimistic. They see that the current situation is very challenging, but they're very optimistic about coming months, which I found was interesting given the weakness that they are coming from. So I wonder whether this is something that is a temporary rebound or whether this is a sort of more of a cyclical upswing.
It's interesting, Klaus, that you bring this up because the experience in the U.S. It was similar walking into this. The U.S. manufacturing sector wasn't doing all that well. Things had been improving in the run-up to COVID-19, and then manufacturing here, of course, got slammed, just like it got slammed everywhere. But in recent months, we have seen it improving. We've seen manufacturing output go up. But it's still well below pre-pandemic levels, and manufacturing capacity utilization is still down quite a bit as well. So it's interesting you bring this up. It sounds like the German manufacturing sector is roaring back to life in ways that we're not seeing here in the U.S. at least.
Yeah.
Okay.
Yeah, I think we still have to watch it carefully because also, in terms of the furloughed workers, there were a lot of manufacturing companies. They were overrepresented in the number of furloughed workers. So there's some conflicting data, but it's it's an interesting trend to watch the coming months.
And perhaps one last thing before I move to the next slide. If you remember, this is a clear difference between the current crisis and 2008, 2009, where the manufacturing sector in Europe was hit very, very strongly. And in this case, we see that it's actually the part of the economy that is more or less doing okay right now in this recovery. I will move to the next slide.
Actually, Laurie, before we do, we just got an audience a question about manufacturing that I thought you could weigh in on. We have here, do you expect that for the last, I think it's a quarter of the year, the manufacturing sector will recover stronger than the service sector for Germany and France? So what are your expectations about services and manufacturing moving into the end of 2020?
Good question, Vanessa. I think a relatively safe prediction is that the manufacturing sector might not do too bad in Q4, because even in case of further restrictions, people will continue to buy goods. So we've seen that during Q3, people bought a lot of goods. So this is something that might continue. Whereas for services, this is much more difficult, because if there is a lot of daily new cases in each one of the countries, then especially in France, I would say right now, it becomes more sensitive. Whether or not there are restrictions, people might be afraid to go to the cinema, for example. Whether there are no yes or no restrictions, people might be afraid to go to a hairdresser. So for services, I'm less optimistic. I don't know, Klaus, if you have a different view.
I completely, I concur with you, for sure. And I think Ataman also brings up a point here that we already saw in Ataman's chart a strong recovery in China. Obviously, that is helping Germany a lot. They have strong export links, supply chain links with China. So I guess they're benefiting from that as well.
Tell us a little bit about the mobility and bankruptcies numbers you have here. This is quite interesting.
So I think the underlying question for this chart is, where is the private sector? Where is the production sector right now? And there are two data that we are watching obsessively. One is the Google mobility data, and we watch them obsessively because they are updated weekly with a very short, the latest data point here is the 9th of October, is last week. So that has been very helpful for us to understand where activity is going. And the other indicator that we are watching obsessively, but with the greatest disappointment that statistics are not updated as often, is insolvency and the bankruptcies of companies. So the question I'm asking here, okay, where are companies? Well, how are companies doing? So if I look at the mobility index, what is interesting is that a lot of workers are actually going to the workplace in France and Germany. So there's been actually an increase in the last month and a half in France, also in Germany the last couple of months, except the very latest data points. So all in all, a lot of people have returned to the workplaces in August and September, even though there's been an increase in the number of daily cases. So I found that data point interesting. I think governments will ask people to stay at home as much as possible again. That is definitely something that Macron will say this evening. I can bet on that. But on the production side of the economy, I think this is an interesting data point. So all in all, mobility until last week was something like minus 16, 17% towards workplaces than pre-pandemic times. So that's one data point. The other data point is on bankruptcies, and there, these numbers tell a lot about the strange times we live in, because what you see here is a comparison of bankruptcies numbers in the first 7 months of the year in 2019 and the first 7 months of this year. And this year, which is the orange bar, they are lower. So there are less companies going bankrupt this year in France and Germany than last year. And in France, the difference is actually quite big. So why is that? Activity was slashed during the lockdown, and companies were obliged in some cases to close for a week, a couple of weeks, or a month. How is that possible? So the answer there is that governments have put a lot of money, and we will come back in one of the next slides with some more details on that. They put a lot of money to help companies bridge, this period until the recovery would start. And basically, they took a number of actions. For example, they said, okay, you don't need to pay taxes now. We can defer the payment of taxation until the end of the year or until next year. Or they put out some special programs for loans for companies. Or they put out programs to say, okay, if you take a loan, the government will back you up and will be the guarantee for the loan. So a lot of money have been put. You have no idea how big this is in terms of GDP. We will come to that in a couple of slides. But so you can really see that the impact of, you can really see here the impact of those measures. Now, what my perception, what I read in the numbers in this period is that we are in a bit in a situation where, it's calm, but there is a storm coming, in the sense that I would expect that mobility goes down again, especially in France in the short term, as cases go up, and bankruptcies will start going up at some point. And many say that in Europe you have the 14th salary payment at the end of the year, and that will be a tough moment for some companies that are short on cash, and they might not make it to next year. So yes, I would say that it doesn't look too bad from these numbers, but both of the two indicators will deteriorate in the next month.
Just to build on those comments, in a normal recession, you normally see bankruptcies increasing because a lot of inefficient firms are going to go out of business if they're not managed well, if they can't kind of control costs, etc. And that sometimes is characterized as a creative destruction process, because it allows for kind of releasing of the inefficient, unused resources so that the more productive and successful firms can grow coming out of a recession. So, of course, this is not a normal recession, so the stimulus is really preventing some of those firms that are in trouble, not through any fault of their own, but because of the pandemic. So they get the help. The risks and inefficiencies are exposed, but they're carried forward. And that might mean that, looking ahead, we might see more bankruptcies and also, along with that, more M&A activity too.
Right. The problem is that this is not, it's a big test for, economic textbooks and government policies, like the biggest of our life probably, because this is not a normal recession. So it's very difficult also for policymakers to take decisions given the scale of the disruption. And I think the intention here is more to preserve capacity than to facilitate the process of creative distractions, because to some extent that process couldn't happen because some market mechanisms are not functioning. well in these times. You know, if you just close the economy, then it doesn't matter. You know, if you want to acquire another one, all of these normal mechanisms are somehow not working right now at this speed and at this depth of the crisis. So yeah, let's see what happens. But it's not easy.
That's a great point, Ilaria. I know you had some material on household savings because there's some strange things happening there as well. Why don't you walk us through what's happening with savings in Europe at the moment?
Yeah. So moving down to the demand side of the economy, I think when we discussed with class, okay, which chart do we select for this webcast? I thought this one was probably the most interesting because you can see two things that are beyond normal. One is the fact that savings rates in Europe are higher than in the US. So you always give me this dirty look when I see these numbers, Eric. And then the other thing is that they increase even. They increase at unbelievable levels in Q2. So you can see here the savings rate for France is 27%, was 27% in Q2 and 21% for Germany, up from respectively 15 and 11. So these are quite incredible numbers. The question everyone is asking, and no one has really the answer, so I would put a lot of question marks on that list here on the left, is what happens with those money. So we only have data until Q2, so until June, and the question is what have people done with that money in Q3 and what they will do in Q4 and next year. So we try to sketch a little bit of an answer, trying to get some, read the coffee, the end of the coffee, I don't know how you say that in English, getting from other data a sense of where that was going. And what we saw is that retail trade was very strong. There was strong retail trade growth until August, which is the latest data point that we have. So people have bought things, consumption moved forward. And we know also from the PMI data that there was strong consumption of goods, durable and non-durable goods, depending what prevailed in the countries, but strong consumption of goods. We see that also from the trade data. Services is probably the pot of money that was saved further. So, and the other thing is a question mark on the housing market. We have this discussion in-house on the US, where you can see that there is some movement. In Europe, this is much more, much less clear. We've seen house prices going up, but not really activity in the construction sector. So not clear answer on that. So probably if I try to put it all together, I would say that a part of those money has not been spent, and also to some extent probably because of a precautionary attitude. And also because service sector is, as we said, you don't feel like perhaps going to, a cinema or a theater if there is an increasing number of cases. So a part has been spent, most on goods. A part is still there, and will probably help. The households deal with possible unemployment increase, because that's, I think, an important indicator. Consumer confidence has been increasing also in September. It went up again, but at the same time, people remain. I think half of European euro area respondents said that they are afraid for their job. So that's why probably some of that money is still there.
No, and it sounds very similar to what we're thinking about here in the U.S. I touched on it earlier on. Again, walking into this, European savings higher than U.S., but still massive spike in both, and I think a lot of that money isn't being spent on either side of the Atlantic. We have a poll question up next, but in the interest of time, I think we're going to skip it because I really want to get into some of this discussion we've been having on fiscal policy support. So if we can move ahead in just the last sort of 10 minutes that we have here, and you can talk a little bit about what's been happening in terms of stimulus and what maybe is around the corner on that front as well.
Okay. In the meantime, I got a suggestion that in English is reading the coffee leaves, so I will remember that. Moving to the policy side, there is a lot of interesting things that can be said there, and we try to organize the argument in three parts. So there is the labor market support, and I see there is a question from Vanessa there on this topic. Then there is the fiscal expenditure of the government, and then there is the European dimension of that, which is very new. So what is different in the current crisis is that there is a incredibly strong attention towards the labor market. Really, I think there's been a clear indication that from how money has been spent to preserve jobs as much as possible. In a way, it was a little bit of a bet, in the sense that, okay, we have the lockdown, we have this big recession, but we bet on a quick recovery, and so we try to preserve jobs and help companies, so try to keep the capacity as much as possible. So the result of that is that at some point in April, close to half of workers in France were entitled to chômage partiel, so to a furlough scheme with pay, which was a number never seen before. I mean, these systems have been existing in many European countries since the 70s, like Kurzarbeit and chômage partiel, so companies are aware of them, they've been using them, but never on that scale. Now, where we are now is that these numbers decrease substantially, and so there is about 500,000 workers in full-time equivalent in France that are still on chômage partiel, and 1.6 in Germany. So in Germany, I have to say I'm a bit surprised on the upside. These numbers are higher than I would have bet. In France, the workers that are making use of those are, without any surprise, I would say, the transportation sector, the sector like the food and accommodation sector, and some services, business services. So those three sectors are still being hit, and at least in two cases, we can expect that this will last longer. On government expenditure, we can organize, or perhaps I take the question of Vanessa. So the question is, do you consider that the labor market in Europe is fragile? And if so, do you think that spending will rise? Okay, so yes, the short answer is yes, in the sense that the labor market reaction has been frozen in a way in Europe. So thanks to the furlough schemes, a lot of people kept their job. They worked on reduced hours, but overall they kept their job. Now, the fragility lies in the fact that it's hard to imagine that, especially in some sectors, these jobs will continue to exist in the future. So, as I said, a lot of companies are still using the chômage partiel in the accommodation sector, in the restaurant business, and so it's difficult to imagine that we keep the capacity at the same level, and some companies will not go bankrupt in those sectors, and this will, of course, influence unemployment. So until now, unemployment figures have been increasing very little, nothing compared to what we've seen in the United States already since the beginning of the crisis, but those numbers will increase, and we have an estimate, some sort of upward estimate in the next slide that Klaus will show you shortly. In terms of spending, it will probably change in the sense that a lot of the expenditure on labor markets has been going until now to these furlough schemes, and this might likely change in the sense that if people lose their job, unemployment benefits will be paid, and so that will slightly shift. Going back to the chart, and I will perhaps accelerate a bit, government expenditure, incredibly high numbers, divided on three buckets, let's say. The first one is the actual expenditure, which is something that is going, for example, to help specific sectors or even specific companies like airlines. The second part is deferral, so helping companies to limit their costs. So a lot of, in both France and Germany, a lot of taxation has been, or social contributions have been postponed. And the other part is guarantees. So guarantees is not actually expenditure, but it's some sort of money set aside for companies. So if companies take a loan, government will act as a guarantee, and there is as much money as 24% of GDP in Germany and 14% of GDP in France. So these are huge, huge numbers. The third part of the policy response is the European policy response, and that is something new. It feels a little bit like here in Brussels, bureaucrats and politicians felt the guilt of the disappointment that people had after the 2018 and 2013 crisis, and reacted much more strongly than in the last two recessions. And so there's basically a new fiscal capacity for Europe. There is a package of 750 billion euros. Part of those are grants given to countries, part of those are loans, but it's something completely new. And there is also a new program called SURE that helps countries paying the furlough schemes. So France, for example, and Italy are entitled to 20 billion euros to pay for their chômage partiel scheme and cassa integrazione in Italy. So that is interesting, an interesting development, and I think it complements the government expenditure part, because a lot of the government expenditure this year has been, giving some money to the cultural sector, giving some money to the transport sector, try to help here and there to keep the capacity of the private sector. But the part of the expenditure at the European level, what they're trying to push is the idea of making projects that are investments for the next year, for the next generation. So that's I
want to give Klaus just the last couple of minutes to talk about our outlook. We talked a lot about what the governments of Europe are doing to push things forward. We have some expectations about what kind of a rebound we might see in 2021. Klaus, why don't you walk us through our projections and sort of the two scenarios that you're thinking about?
Sure, Eric. Yeah. So just to indeed to wrap it up, all these findings, where does it leave us basically? So we have here the 2020 growth rates and the 2021 growth rate, our expected next year forecasts. We divided them up into two scenarios, a little bit like Eric presented for the US as well, where the first scenario is the most positive one, where we assume that most industries reach their pre-pandemic output levels by the end of next year. Even some will be above it, like retail trade, information and communication, which you already know have done pretty well actually over the last months. And some sectors that are still struggling by the end of next year, obviously transportation, accommodation, arts and entertainment, those sectors. So that's sort of our assumptions underlying the positive scenario. The negative scenario assumes that there will only be a couple of industries back to pre-pandemic levels by the end of next year, and that most will actually still be struggling to revive their previous output levels. Now, as we already talked a bit about in the webcast, we think that the overall impact in France is stronger than in Germany. So that is reflected in the 2020 growth rates, where Germany is -5%, around -5%, and France more in the range of -11%, which, by the way, brings it closer to some of the other large European economies. You see the UK, Italy here, Spain it's expected to be worst hit. Then for next year, a strong rebound, obviously, for France, a stronger growth rate than for Germany, but of course part of that is just a simple base effect. And then obviously for the weaker scenario, we expect a much weaker growth rate to persist next year. Now finally, Ilaria mentioned the labor market. There was also a question on that. So based on scenario 1, we put our expected unemployment rates by the end of this year compared to the value for January. You can see that for all countries, we expect the unemployment rate to increase despite all the strong government support. Job losses will be inevitable and will be stronger in some of the more liberal labor markets like Spain and the UK. But also in Germany and France, we expect unemployment to increase. So with that,
thank you so much, Ilaria and Klaus, for this great presentation on your thoughts on these two really important countries. And thanks to the audience, and thank you to Autumn, and of course, for walking us through the global perspective as well. Feel free to stop by next month. We'll be looking pretty closely at our annual Global Economic Outlook, where we'll be really discussing really big picture themes on the global economy. So that will be next month on or around November 11th. It probably will have to be rescheduled because that's a holiday in the U.S. Feel free to stop by our COVID-19 hub on our website. We're constantly putting out new research and infographics and thinking about the economic implications of the virus. We put together a great podcast as well called Indications. We encourage you to listen in. And finally, we always love feedback. You'll have a survey offered to you in just a few seconds, so please feel free to fill that out. Again, thanks so much for joining us, and we'll see you next month.